Fundstrat Global Advisors Head of Research, Tom Lee, joins us on set today. Hi, Tom.
Hello.
So based on what Taneo was describing with regard to Bitcoin, what do you think that this most recent rally says about the overall risk appetite in the market right now?
Well, it's really telling us investors are pro-risk. I do think it also just signals how much capital has been idle for the last couple of years, either parked in money market cash or waiting to see if the economy survived. So I think Bitcoin rising is to me, breaking out of a holding pattern is a precursor to what the S&P is going to do the rest of the year.
Speaking of the moves in the broader markets, you say the road to 6,300 is paved with bumps. What do you expect investors to see ahead that may slow them down? What are some of the key markers that you're looking for?
Well, I think there's a lot of macro to digest the next 3 weeks. Tomorrow is the jobs report, and I think investors are fearful that it's going to be too strong because of the hurricane and seasonal adjustment, so it's going to be a big number. Next week is CPI, which has been running a little hot, and Fed Chair Powell spoke about that earlier this week. And then, of course, on the 18th is the FOMC rate decision. So I think once we're through these events, investors can actually then invest into sort of that Christmas Santa Claus rally. So I think 6,300 is still very doable.
So you're basically saying don't go away after the 18th because there may be some additional upside toward the end of the year?
Yes, or buy the dips, yeah.
So, you suggest there that we're in a good news is bad news for stocks environment. Why should the market be concerned if the Fed is going to be less aggressive in terms of cutting rates?
I think there's a conceptual change that the market has to get used to, which is, let's say earlier this year when the Fed started cutting, people thought, 5 cuts is good for stocks in 2025. So if the number gets reduced, it's bearish. I think as we get into 2025, the market's going to shift to thinking the fewest cuts possible next year is the best case because it elongates the dovish cycle. So I think we have to flip the script, but it's going to take some time.
But hasn't that been the case all year? Because in January of this year, the market was implying 6 or 7 cuts. We're only getting a few. We've slowed the pace. The 2-year yield is not that far below Fed funds anymore. So I guess my point is the market's already kind of registered that slower is better.
That's right. I think it's, I would just say it's not a consensus accepted view because, for instance, when Fed Chair Powell spoke about taking things a little slower, the market got weak and then maybe had a rethink. So I think it's going to take a while until markets realize 1 cut next year is actually quite bullish.
Are you surprised that equities haven't reacted to some of the political turmoil abroad, South Korea, France, elsewhere?
In some ways, I think the stock market had been already pricing this in because, as you know, this year has been a pretty significant divergence between U.S. versus Europe and U.S. versus emerging markets and even China's sort of failed rally. So I think in some ways the market's not surprised. Maybe it was even pricing in this through currencies and equity prices.
Tom, I'm going to go back a long ways to our long relationship. Do you still even track active managers and how much, they're trailing their bogeys at all, and whether that's a factor in any way at the end of the year?
Yeah, in fact, we've been cleaning up that data because, as you know, in the last 10 years, there's been a big change in the number of managers. It's good. It's kind of a good and bad year because active managers that tactically went cyclical or more offensive or tech have been having banner years. We have so many clients that are beating their benchmark by 6, 7, 8. These are unheard of outperformance, but it's a small number because, as you know, when you look at the world more towards macro or market neutral, it's been very tough.
The financial community was prepared for the anticipated 25 basis points rate cut, which was seen as a nod toward bolstering economic activity. However, it was the unexpected shift in the outlook for 2025 that truly took center stage, leaving many to ponder the future of their portfolios. Jerome Powell, the esteemed chair of the Federal Reserve, adopted a more hawkish stance, casting a significant shadow over markets, particularly impacting the volatile cryptocurrency sector. Titans of the digital currency world such as Bitcoin and Ethereum, alongside leading altcoins like XRP, Solana, and Dogecoin, found themselves caught in a downward spiral, plunging to worrying levels that shook investor confidence. This development is hardly promising news for those who have been bullish on digital assets, witnessing their value defer to bearish trends. Welcome back, everyone, to Investocracy Crypto.
Should we be surprised at this resurgence, this melt-up? And it's maybe caught some people by surprise?
I think investors should realize 2024 has been a year of surprising strength. The market has avoided so many opportunities for weakness, and now we're entering the final weeks of the year where we know there's still $7 trillion of cash on the sidelines and quite good visibility in next year. So I think stocks should finish very strong.
Why do you think money is going to the mega caps now in the manner that it is? Up 1.75% today, the NASDAQ up almost 4% over a month, and able to achieve this milestone.
One reason is mega caps have been leading. So it's sort of what people reach into the shelf when they're risk on. But second, we know that when interest rates fall, the mega caps actually are very sensitive to that. And I think today was a day where the odds of a December cut increased. You know, the probabilities are now solidified, and that's actually bullish for tech.
Let's delve deeper into the reverberating impact of the Fed's recent announcement across the financial sphere. In the wake of the anticipated 0.25% rate cut, the Federal Reserve dropped a veritable bombshell by revising its outlook for the year 2025, stirring not just the stock market, but the very foundation of economic forecasting. By reducing the number of projected rate cuts from 4 to an unexpected 2, Chair Powell has signaled a warier and potentially inflation-conscious path forward, ultimately suggesting a nuanced approach to managing economic growth and inflation. This decision, akin to an unwelcome guest making a surprise appearance at an otherwise joyous event, has stirred up quite a dramatic response across trading floors and among financial news circles. It's a rare day indeed when one witnesses Bitcoin plummeting to $100,314, representing a 5.4% decrease, which significantly contributed to an astonishing $200 million reduction in the overall crypto market capitalization, leaving many digital asset enthusiasts in disbelief. However, it's often remarked that the stock market is a peculiar place. It's the only marketplace where, when items go on sale, people have a tendency to run for the exits rather than the entrances. This latest market dip may present the very opportunity that astute investors have been keenly waiting to seize, especially those with a keen eye for discounted growth potential.
Because the CPI was, some would say sticky, but it was largely in line. Is that how you read it?
Yeah, that's right. And I think it's allowing the CPI print today allows people to imagine a path to 2% because shelter now is cooling to a level that's in line. Auto insurance, which was at 25% earlier this year, year over year, is now down to 13%. So the two biggest contributors to CPI are in a downshift. I don't think the fact that used cars are going up is going to reverse the Fed's view. I don't think the Fed's going to tighten because used car prices are up.
All right, so Fed's cutting next week. That's your base case?
Yes.
And then what happens after that? All bets are off? Wait and see? What do you think?
I think the Fed put remains in play because neutral is, let's say, 2.5% to 3%. We're at 4.5% after the December cut. So we know the Fed's in a cutting cycle. I actually think the best case is for the Fed to do the fewest number of cuts next year.
That means the economy is pretty strong.
That's right. It's strong. They're not harming the economy by keeping rates here. And the labor market is holding up, and now we have a lot of firepower for future cuts, which support stocks.
Okay.
In the meantime, the consequences of this shift have not spared other digital currencies either. Prominent assets such as Ethereum, XRP, Solana, and Dogecoin have all experienced notable declines, with liquidations exceeding an impressive $675 million within a single day, a stark reminder of the volatility inherent in these markets. As analysts continue to process and interpret this news, the increasing correlation between traditional market dynamics and crypto movements becomes ever more evident, as highlighted by the S&P 500's sharp and concurrent downturn. It is evident that the fate of the broader market is intricately interwoven with the strategic movements enacted by the Fed. Investors are now left to ponder the broader implications of higher expected inflation rates, which have been adjusted upward from 2.1% to 2.5% by 2025, projecting a need for heightened vigilance. With conversations and debates abounding in financial circles, an essential consideration is whether this juncture represents a timely buying opportunity or merits a more cautious, steady-handed approach. The probing questions are aplenty. Will the market correct itself, or is this indicative of a deeper financial shift? But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
But you say that is a substantial part of your outlook for the new year. The Trump put, explain.
The Trump put is, on the simplest level, it is a White House that is going to measure its success by how the stock market performs. but it's also a president that's coming into a second term, but with a lot of previous experience. So this is a cabinet that has good private sector acceptance, and I think very markets friendly. Overall, I think investors who might have been cautious for the last few years now want to be risk on next year.
All right, so your outlook to me is interesting, the way you sort of game out where the S&P can go, because you say we're going to 7,000 by mid-year, which sounds amazing because most targets that I've seen are 7,000 at the top end for the entire year. Your full year forecast, though, is 6,600. Why?
Part of it's cyclical. We're coming off two back-to-back 20% years, and there are 5 precedents to look at. 5 of the 5 precedents since 1880 had a weaker second half. So I'd say that's the base case. The reason I think markets do better in the first half is that there is going to be a lot of enthusiasm about a new White House, some of the headlines that come, whether it's deregulation, et cetera. And we know there's still a ton of cash and a lot of low leverage on the sidelines. That's why stocks can rally. And by the way, 11% in a few months, we've seen that routinely the last couple of years. But in the second half, I think markets start to worry about the larger macro risks like the Middle East, the potential risks of tariff and executing that, and potentially the fact that Doge could be so successful that it could slow the economy.
In the ever-evolving and highly dynamic financial landscape, where unpredictability remains the single constant, the Fed's prudent and cautious outlook adds a compelling dimension to contemporary investment strategies. Despite the immediate turbulence shaking various markets, seasoned investors might see in this turmoil an opportunity to secure potential value in currently depressed assets, speculating on substantial long-term benefits once the economic storm inevitably subsides. The present downturn could very well be positioning stalwarts like Bitcoin and Ethereum for potential future growth, especially when considering their historical resilience and robust rebounds from previous market fluctuations. Traders are vigilantly monitoring as Bitcoin stabilizes around $100,314, while Ethereum continues its strategic dance at lower valuation levels, revealing paths of resistance and support that may define upcoming trajectories. With a number of analysts forecasting ultimate growth once the dust of the current upheaval settles, the overarching question remains: could this be a golden opportunity to invest amid the existing chaos? As we draw this discussion to an end, we invite you, the astute viewer, to share your insights and perspectives. Are these financial tremors merely a cause for alarm, or do they represent a calculated and strategic risk that is well worth taking? Join the ongoing conversation and impart your take on the market's current trajectory. Engage with your peers and experts alike as we collectively navigate these turbulent yet intriguing financial waters. It is only through shared dialogue and learned insights that we can hope to make sense of these complex and challenging financial times.